All right, we got a good crowd here. We got Roldan, welcome back, Roldan, Rich Glover, Michael Foster, John Sexton, John Henning, Everett, welcome back, Everett, pop. I'm
Good to
gonna
see you all.
start going live right now.
Good to see you all. What's new, everybody? Put something in the comments that's new and exciting. What's the best thing that's happened to you all day so far? Let's put it in the comments. See what we got here. What is the best thing, Paulo? What's the best thing that happened to you all day?
I was about to say, yes, man. Today was like one of these magical days where it looks like Hawaii out there, man. Like it was these like big waves that were out there. It was a beautiful morning. I was there right at 6 a.m. I could not have started my day any better. It was fantastic.
It's awesome, man.
How about you?
Um, I had a really great morning with my kids. My kids are awesome, and I've been trying to figure out ways to help them convince themselves that they want to go outside more often and soak up all the sunshine. It's tough being at home all the days and with everything that everybody's going through. So, I have a 5-year-old and a 7-year-old, and this morning I came through with a breakthrough that they were very, very excited to get outside today. There's a gold coin system that we've implemented in the Cohen house, and rewards based. And they're excited. So hopefully after we're done with the show here, I go home and they're in the pool. That's what my big hope is. I think we'll be there.
Awesome. Well, we're right on time. We just went live. Welcome everybody to, Everett said my daughter's 9-year anniversary. So 9-year anniversary. Oh, today is Whitney and Rich's anniversary today.
Oh my goodness. All right. They're getting a call after this.
All right. We got to give them a shout out. Thanks for letting us know, Everett. Roldan locked up in real estate agent willing to partner for subject to deals.
I'll explain that one. So Roldan's, he just put his first property under contract. Now he's doing it on the active side right now in preparation for building up the passive side. He and I have chatted on social a bunch, and he just started his real estate education program with Fortune Builders. And I believe it was within less than 2 months, he locked up his first deal. So I think he's sharing the success of that first deal on the active side of his business, which I'm super proud, super happy for you, Roldan. So that's really exciting.
That's excellent. All right. Well, welcome everybody. We're live on Facebook. We got Lee Bishop. He's actually on Facebook. He's saying hello from Facebook. Hey, Lee, good to see you again, my friend. And this is the Q&A version of the Not Your Average Investor show that we do on Thursdays at 12:30. A little bit of housekeeping. It's me, Pablo Gonzalez, your host, Gregg Cohen, my co-host. Say hello, Greg.
Hello, everybody.
And little bit of housekeeping today, right? We're going to keep it small. If you want to chat with us, we welcome it, right? Like it really helps us. Marla's on the Facebook group. Hey, Marla. It really helps us when people are submitting comments, submitting questions. It really gets us going. If you don't do it, that's fine. I'm still going to be picking Greg's brain, but it'll be much more fun if you contribute. So if you can pop into the chat, drop down on the Dropbox and put all panelists and attendees, you can interact with us. And if you have a question that wants to be asked on air, go into the Q&A box. It's a different button on the bottom, and you go in there, you pop in your question, and we're going to try something new. If you have a question and you want to interact with us on air, there's a place where you can raise your hand and I could call on you and I can bring you into the call. So if anybody is feeling brave enough and wants to talk to the Gregg Cohen on the Not Your Average Investor show.
Watch out now.
We're gonna try that out today. So we're encouraging interaction. And of course, if you want the personal advice, if you want to know how rental income properties fit into your portfolio, if you want to build that into your plan, to your retirement plan, go to chatwithjwb.com, pick out a time that's convenient for you, hop on the phone with our guys, and we'll walk you through it. It'll be pretty easy and a good experience from everybody. So without further ado, we got Marilyn chiming in from Homosassa, Florida, which she has told us where it is. Gulf Coast, right next door to Crystal River, home of the world famous manatees.
There we go.
Have you ever been to Crystal River?
I have no idea what Crystal River is. That's the next time I'm going to call out Maryland.
It's just north of Tampa, and you can go diving with like all these manatees that hang out in these like springs in this river when it's like wintertime, right? So
really?
Yeah, that's what it's known for. I've been dying to go there, and I have a buddy that lives out there. It's supposed to be really, really pretty.
Nice. Well, we have a friend out there now. Good to have you, Marilyn.
Yeah, now we know. All right, so let's get started. Greg, I want to touch on a couple of your uh, internet phenomenon real estate walk and talks. We were just talking about how you're getting a bunch of interaction. You have people coming out of the woodwork asking you questions, and I think that you're starting to put a bunch of value out there. But one of the ones that you had this week was, how much do you need to get started in rental income property investing? Can you kind of talk us through that a little bit?
Yeah, absolutely. And I appreciate everybody who is showing up on these walk and talks. I do them every day now. I tell you what, if you had asked me a year ago if I would be that guy who's posting on social every single day, I would have told you absolutely not. But now that I've been doing it for like a month or 5 weeks now, I tell you what, I'm having a lot of fun with it. And it's because of you all who are interacting. I'm seeing the same names and faces there every single time. So thank you all for being there and for making it fun. So one of the questions that we get a lot is, how much money do you need to start investing in turnkey rental properties in Jacksonville? And that was one of the walk and talks. So typically, for our clients, you'll be investing with conventional financing. About 60% of purchases are through conventional financing. So I'm going to assume the numbers based on that. A typical new construction turnkey rental property in Jacksonville with JWB will cost between $160,000 and $200,000. But most people are going to use conventional financing. So that doesn't mean you have to have hundreds of thousands of dollars to begin investing in one rental property. Normal conventional loan products through the government-sponsored entities, right? Fannie Mae, those types of loans, very vanilla loans, are what our clients are getting. And generally, you'll put either 20% down or 25% down. And the net at the minimum, what you should expect is about $40,000 out of pocket to include your down payment and your closing costs to buy one rental property. That's what would get you started.
Okay, so it's $40,000 out of pocket. I know that you talk about unexpected costs and stuff like that. Do you also need to have a little bit of extra cash on the side for that property itself?
Absolutely. We talk a lot about reserves. And even before you invest in a rental property, and especially if you talk with my team, we're going to talk a lot about what are the downsides of investing, right? And your biggest pain points for a rental property investment are your maintenance cost and your vacancy cost, right? So you need to have something planned to be able to handle the ups and the downs. And it depends on how many rental properties you have, is how much you should have in reserves. Again, we would walk through this with you before we actually build everybody's plan out for them before they start investing with us. You can sign up to have that done for you at chatwithjwb.com. And we'll plan out your maintenance reserves. But just generally speaking, if you're buying one rental property, have about $5,000 in a bank account somewhere, and just make sure it's liquid. You can invest in something, just make sure it's liquid, and just have that there as a rainy day. Because what you don't want to happen is you don't want to have an unexpected maintenance or vacancy item happen. And the worst thing, and I've seen this, right? The worst thing is that when we're preparing, where we're performing for a client, we're hitting those return expectations, but an unexpected event came maybe like 3 years into it or 4 years into it. And it might have cost them a number of thousands of dollars, right? So overall, we're still hitting our return expectations, but it was just one hit at one time. And it can create a negative situation if that client hadn't prepared for that in advance. And it can create some sleepless nights, right? We don't all have thousands of dollars sitting around ready to invest. Especially, it really pains you if you have to do it for your rental property, right? So that's why I want to avoid that. I want to hit your returns, and then I also want this to be a fun experience for you. And one of the ways to do that is prepare for those rain days. So have it in a different bank account or in a liquid investment, and just have, maybe $3,000 to $5,000 set aside for one rental property. And the good thing is that as you build up more and more rental properties, you don't need to have $3,000 or $5,000 every single time set aside. Do you know why that is, Pablo?
I don't know why that is, Greg. Tell me, please.
Well, it was a part of the other walk and talks. I don't even know if you're paying attention, Pablo. Come on, man. I'm just joking. Well, as you build up more and more rental properties, what I really do want you to get to is 3 rental properties, because that's what can be a consistent portfolio. And when you get to 3 rental properties, what's going to happen is you're going to have an issue with one of those properties every number of years, right? But at that time, the numbers would show that you're going to have 2 other properties that are going to be overperforming. And so what will happen is the overperforming nature of those 2 will offset the underperforming nature of that one at that one time. And that's how we create a consistent portfolio. So you don't need to have $15,000 set aside if you have 3 properties, because now you've got a consistent portfolio with multiple and diverse set of properties. So there you go.
That makes a lot of sense. And for the record, it made a lot of sense the first time I heard it on the walk and talk. I just, like you always do, the moment that I start getting distracted with something technologically, that's when you like stop and you ask me a question, and then I completely freaked out there. So
I've been waiting to stump you. You've been really good with all the other times, and I
Yes.
stumped you. And I'm gonna write that down. I'm gonna give myself a gold coin today because I stumped you. Way to go, Greg.
There you go, man. I'm real proud of you, buddy. All right. So John Sexton actually has a question here. Thanks, John, for contributing, man. John Sexton asks, once a tenant leaves, what are the typical items that are addressed to prepare the property for the next tenant? How long does that take, and what is the expected cost?
Yeah, it's a great question. Again, I like talking about what your main pain points are going to be before you start investing, so you're prepared, right? And your main pain points are going to happen when that tenant leaves, because one thing that most people don't tell you is that this idea that you can turn a property over, meaning that first tenant leaves, you put the next tenant in, that you can turn that property over and not come out of pocket, is not true, right? It's just not real. It's not a realistic expectation. Can it happen every once in a while? Sure. But we manage 3,500 rental properties. I don't see it that often, right? And when we sell a rental property, we put maintenance expectations in there because I fully expect you to have to come out of pocket when that property turns over. It just normally happens. So on average, it'll be about a couple $1,000s net to the investor when that property turns over. And what we're doing there is we're putting it into great rental shape so that it can rent quickly for the next investor. One thing I should point out is you do get a security deposit that is held, right? If there are expenses that need to go back into the rental property, it's because the resident didn't take care of number of items, right? There's a security deposit that we would get on your behalf that would go towards that. But the net effect is still somewhere around $2,000 of out-of-pocket expenses for you outside of that, right? And it all works, right? It all fits in with those return expectations that we're talking about, but that's real. So you should expect a couple $1,000s out of pocket every single time. The market to move in time for us is around 40 days. So, I like to promise and over deliver even to myself when I'm investing. So I think about a couple of months of vacancy for us to turn it over, right? Historically, it's about 40 days for us. And then what does it mostly spend on? It is, kind of like death by 1,000 cuts. When you look at the scope of work is the way I think about it, right? It is a whole bunch of small items. It's general wear and tear that you're fixing, right? It's paint, right? If there's some issues on the flooring, right? Flooring is something that we have to address. It's blinds. It's just a lot of things that just add up, but by the time that we do those things, this house is going to pop in the eyes of a renter, because the biggest cost for us is your vacancy cost, right? Going an additional month of not having that house rented, might cost you $1,000. So we want to put this house in the best possible way. We obviously know what is going to matter in the eyes of that new prospective resident, and we're going to do that. But when you look at a scope of work, that couple $1,000s, you're not going to see like, 3 or 4 items. You're going to see like 20 items, and they're going to cost a really small amount. And those are just the little things that we have to do to get into great rental shape for you.
Makes a lot of sense. I've got a bunch of questions flying in, right? I'm going to get to all of them. Marla, I'm going to get to your question next. Aaron, I'm going to get yours. Roldan, I see yours. Mac, I see yours. Thank you so much, everybody, for contributing questions. Everett, I know that you asked a question about multi-units. We're going to talk about that because we're going to want to talk about townhomes in a second. But first of all, Marla Alberti is asking, what if you don't have 40K to put down, Greg? I know that you got some creative solutions for that.
Marla, it is so good to have you here. I know you've been commenting on the walk and talks and in the group there. And I was thinking of your question when I did the walk and talk this morning. I literally did it about 20 minutes before we jumped on here. And if you guys go and look at that, it is, how do you get started investing in rental properties if you don't have $40,000, right? So I came up with 4 strategies that I've used and that I see others using to get started in rental property investing, even if you don't have $40,000. Now, as just a word out there, I try very hard not to speak like a lot of real estate gurus or experts who come up with no money down strategies, right? That is not the right mindset. This type of investing in rental properties, it is not your no money down deals, right? You should expect that there is going to be some capital to outlay to invest in rental properties. But that doesn't prevent you from doing some of these strategies that I'm talking about right now. So The first one is to look into your retirement accounts, right? You may already have capital that you just didn't know was there because you might not be aware that you can actually invest with money that is in your retirement account. You can start building your rental property portfolio with those funds. So if you feel like you don't have $40,000 of capital to get started, the first place I would look is to your rental property, to your retirement accounts, because you may actually have the money there. And if you have questions about how to access that capital, again, talk to my team. We are experts on how to do this. Chat with JWB.com is a great way to set up an appointment to do that. So the second way to do this is, you know what? I have it written down here. I don't know. I got the third one. We'll go with the third one second. All right. Is to, no, I got it now. The partner up. All right. Partner up with your, to be able to buy your first rental property. So this is what I did. When I was 23, I didn't have any money and I had a lot of big dreams and I knew I wanted to invest in rental properties. And I was like, listen, I don't have the money, but I have great credit at the time to be able to get a loan. How can I make this possible? So then guess who I called? I called Pops. Pops was like, oh man, what is he calling me for? He wants the money, huh? And so Pops was like, all right, so lay it out for me. And what I did was I showed him how we could partner up. I would take the loan, right? I would bring the credit. He would provide the down payment for me. And then in a sense, we partnered up on the first rental property that we bought. And that is something that you can do. So the money still has to be there, but you might be able to find a partner who can bring the capital or some percentage of the capital. You may bring the credit. He may bring or she may bring the credit, but there's an opportunity to partner up to be able to get the capital and the credit to be able to do your first deal. All right. Should I keep going?
That's two, right? You said you got two more?
That's two. And I don't know if this is number 2 or number 3, but this next one is more of an advanced strategy. So this is using a home equity line of credit to be able to access capital. All right. So think about it. If you are an investor in California, New York, Virginia, New Jersey, some of these very high priced markets, you've seen your values of your properties go up over time and you have equity there. Well, equity is great, but equity does not help you increase your passive income if it's just sitting there. So if you have a tremendous amount of equity there, you know, to steal a common phrase from my good friend Keith, who runs the Get Rich Education podcast, your return on equity is 0 if it's just sitting there. All right. So a home equity line of credit allows you to access that equity and to be able to use it. Now, this does not mean that you take out a home equity line of credit and you go and spend it lavishly on things that you don't need, but you can make the numbers work so that you can invest that equity and turn it into a passive income stream. And the great thing about it right now is that interest rates for home equity lines of credit are incredibly low, right? Because of the economy that we're in right now. I just looked at one of mine and my interest rate is 3.25%, right? So if you've got potentially hundreds of thousands of dollars in equity in your home and you live in one of these high price markets, you can go to a bank, and almost every bank would offer this for you. And you can access the equity that you have in your home, be able to borrow it at maybe 3.25%, 3.5% interest, and turn around and use that as a down payment to be able to fund your first rental property.
That's interesting. That's so that's like the solution of like house rich, cash poor, right? Like you take that rich of a house and then all of a sudden you have this cash flow that comes in from it.
Yep. And I love home equity lines of credit. It's a great thing to do to get, because typically there's no fees to get them. Like for the one that I have on my personal residence, I didn't even have to pay for the appraisal. There were no fees. And it's just almost like a really great credit card that you have, and you use it when the time is right. And that doesn't mean you go out and you spend money on trips and stuff at big screen TVs, right? But if there's an investment that can help you start to build your rental property portfolio or something along those lines, and you can borrow the money at 3.25%, it's a great tool for you to be able to get started right there.
That's brilliant. So I know that there's 4. Marla, I'm going to recommend that you go to the walk and talk from today. I want to get to a couple of other questions, and maybe we'll circle back around if we have a little bit of time at the end.
You're going to tease them with the 4th one.
It's a teaser. You're going to have to tune in the mornings. All right. Roland Crebo asks, can a Jack's local business owner utilize equity from his business building to purchase rental properties?
So now we're talking about a commercial building. It is much more difficult to do it from a commercial building. So when I'm talking about a home equity line of credit, I'm talking about your primary residence. When I started investing back in 2006, you could get home equity lines of credit on investment properties pretty easily. But since 2008, when the real estate market and the lending market obviously took a nosedive due to the Great Recession, they pretty much stopped all home equity lines of credit on investment properties. It's very hard to get. You have to, it's just generally not available to most individuals out there. It would be even more difficult to be able to get a line of credit on your commercial property. However, you can get a normal loan on your commercial property. So you may have equity in your building. It just wouldn't be a home equity line of credit. It would actually be a refinanced loan. And that might be a great way to be able to pull out capital. And especially right now, that might be a good thing to look at because interest rates are incredibly low. So refinancing might not be a bad thing, even if you didn't want to pull out capital and invest in rental properties. It might be a great thing to do, just simply to refinance and lower your payments for your business expense there.
There you go. All right. We have questions from somebody that I think there's a new name in the chat. Welcome, Mac McGowan. I'm just going to throw it out there. I think that's an awesome name, Mac McGowan. Like it goes well with the, it's fun to read. Anyways, Mac McGowan asks, how much and what type of insurance should I carry on a new townhouse in Jax if the value is around 155K?
You know, that's a great question. I don't have the specifics right now, but I know that you literally are one phone call away from getting all the specifics. So, and on every townhome that you would purchase through JWB, you're going to know exactly what your insurance costs are going to be because we actually get that quoted with the Ritchie Insurance Group, who Whitney
Happy
Ritchie.
anniversary. Happy anniversary.
Happy anniversary. Happy 9-year anniversary to her and Rich today. Whitney is a big partner to JWB, and it's a huge partnership that really values the client who is purchasing because there's no surprises when it comes to your insurance costs. So like, for example, if you purchased a townhome for $155,000, it was a JWB townhome, you would see on your property evaluation that the insurance cost may be, $500 a year. That's not just an estimate. That's already been quoted because the Ritchie Insurance Group already sees the inventory that's coming up. And that's how we know exactly what your cash flow is going to be. So, I don't know all the specifics on exactly what insurance you can get, but you're one phone call away. Just go to chatwithjwb.com, talk to my team. They'll get you all the specifics, exactly what you need to know for that insurance product for that.
Yeah, Mac. And I think Whitney was either episode 3 or episode 4 of the Not Your Average Investor show that you can watch on YouTube. She's awesome. She's the coolest. It's a really great episode. He also has a follow-up question. Who do I get proof of HOA from when I buy from JWB?
Who do you get proof of HOA from?
Oh, proof of HOA fee from when I buy from JWB.
You get it from JWB. I mean, we would have that information. We'd share that with you. When it comes to HOA fees, you'd be responsible for actually making the HOA payment. JWB isn't responsible for making that payment for you, just like we're not, at the end of the day, responsible for paying your property taxes for you. Generally, if you have a financed loan, the bank is going to escrow that and pay that for you. Or if you don't have a loan on it, you'd be responsible for paying the property tax. Same thing with an HOA. So when a client purchases a property that does have an HOA, we would share all that information with you, and then you can just set up those automatic payment reminders and make the payments.
Great. And Mac and everybody else on this call, because I'm about to ask you a long question. So everybody else on this call, Mac especially, chatwithjwb.com to get your very specific questions answered. It's a really, really easy process. You're not getting on with like salesy people or anything like that. It is a value add conversation that you're going to have with our sales team that can explain things in fine detail. So you just go to chatwithjwb.com. You can set up an appointment link right there. It gets set up automatically, and you can talk to our team. Also, if you are new, which I think you may be, Mac, to the JWB universe, we have a webinar online that teaches you the fundamentals of rental income property investing. You can find that at jwbwebclass.com. Gregg shot it. What was it, last week, 2 weeks ago, man?
Man.
That we're in the office.
Fun. You were right there with me too.
I was fun. We tried to make it like the most efficient use of time to really explain exactly what you need to know. We put a lot of thought into it. I think it's really, really valuable. I suggest you go to jwbwebclass.com if you really just want to know the fundamentals of why this thing works well and why JWB does it unlike anybody else. And I suggest anybody go there. So Gregg, there's also one last thing I want to mention before I get into, we're going to get into townhouses and multi-units and stuff like that, because we have a couple questions about it. I also want to mention that through the end of May, JWB has the mortgage guarantee, where they guarantee your mortgage payment for the next 6 months for any new properties under contract. Greg, do you want to say a little bit about that?
Yeah, it's a great opportunity. You know, it's in response to COVID, right? Generally speaking, we have, you know, a great success rate when it comes to collecting rent, right? And at the same time, we sign long-term leases. So we do that, and we feel really comfortable about people coming to JWB and having positive cash flow from day one. That is the right way to do this. And I still feel very confident about that, even though we're going through COVID, right? But I understand people are reading a lot in the news, and, you know, there's just general concerns. You're reading out there how people aren't collecting rent. Even though we are, you may have that concern. So anyways, so what we do now is we do what's called a mortgage payment guarantee. It is only through the end of May. So it's not going to be extended beyond May. But for those clients who put a new property under contract, what you would be able to do is to have your first 6 months of mortgage payments in essence guaranteed by JWB. What that means is that for any reason your resident didn't pay the rent because of anything, JWB would make a mortgage payment equal to you in the amount of your mortgage payment. And so it removes the possibility of negative cash flow for you. It protects you. It's something that we are really confident about because we're collecting great rent anyway, so it's not a huge risk to us. But it might just reduce that last question that a new client may have. But you do need to put a property under contract by the end of May. It's coming up to the end of May. So it's something that if you're interested in, I would highly recommend jumping on the phone with our team. And it's available to current clients as well. So, you know, it's there for all of you, and we're excited about it.
Great. So we're coming up on the half an hour. That's why I got those maintenance things in there. We're going to stay a little bit longer, but we want to respect anybody's time who only had a half an hour cut out for this. So Greg, Everett asked early on in the chat about, will you ever get into multi-units, like 2 to 4 units? And I know that you had a real estate walk and talk this week about townhomes versus multifamily. And first of all, I just wanted to ask you, I didn't really know much about JWB's involvement in townhomes. Can you just kind of say how, you know, I guess Everett says, well, you get into multi-units, 2 to 4 units. That sounds to me like townhomes. Can you kind of break that down for me?
Yeah, let's first talk about what the difference between a townhome is and a multifamily unit. They're not very different, right? Really, the difference is how they're owned. So you may have a building that has 4 units under one roof or 6 units under one roof. And that may be a townhome or that may be a multifamily, right? That townhome or that multifamily, you both get the economies of scale of reducing expenses because you only have one roof, right? You both get mitigating factors for your vacancy costs because you've got, let's call it 4 tenants under one roof, right? So one isn't paying, you got 3 other tenants that are paying and offsetting. So you've got all those benefits, whether it's a townhome or a multifamily. The main difference is how they're owned. So in a townhome, if it's a 4-unit townhome, there are 4 individual units that are owned individually. You may have 4 owners. You could have one owner that owns all 4 individual units. If it's a multifamily and it's got 4 units under one roof, that's always one owner, and you may just have 4 residents that are living in those individual units. So it comes down to ownership, all right? So we get a lot of questions at JWB, you know, can I invest in multifamily properties? And, you know, I very rarely get the question of, hey, can I invest in townhomes with you guys? And I'm like, why is that, right? Because there's actually a lot of advantages to investing in townhomes over multifamilies, specifically in Jacksonville. So I did the walk and talk about that. I'll kind of share those advantages here. And there's also a downside to townhomes versus multifamilies as well. So I'll talk a little bit about that too. But the number one advantage for townhomes in Jacksonville, Florida over multifamilies are the neighborhoods. All right. So, and this is going to answer Everett's question. Will we get into multifamilies? The main reason that we are not in multifamilies is just the housing stock in the neighborhoods that you want to be investing in Jacksonville do not lend themselves to multifamilies. The type of housing that was built many, many years ago is not conducive to a multifamily property. It just wasn't built that way. And it's really hard to build new construction in the neighborhoods that you want and to have the right variances and the right codes to be able to do it for multifamily. It's just not easy. So the number one advantage to townhomes in Jacksonville specifically is that there are tons of townhomes, and JWB builds a lot of townhomes, and they're in the right cash flow neighborhoods for you. So that's a great thing to do. You don't want to just get excited or infatuated about multifamilies and then go into those other neighborhoods, low income neighborhoods where you're going to see a lot of maintenance costs, vacancy costs, turnover. You don't want to go searching in the wrong neighborhood just to satisfy this idea of being in a multifamily property. So housing stock available in the neighborhoods you want to be in is the number one advantage for townhomes over multifamilies, specifically in Jacksonville. Next comes down to financing. So financing is tougher for multifamilies than it is for townhomes. All right, Pablo, I'm going to quiz you on this. I would doubt if you would get this. I'm kind of setting you up for failure here, but think about it this. All right, so there's not a lot of housing stock. Why do you think it might be tougher to maybe get an appraisal on a multifamily property if there's not a lot of other multifamily properties around? What do you think?
Because for comparison reasons, you need data. Like the more comparisons you have, the better the data is.
You killed it, brother. Totally redeems yourself. Yeah, it's great, man. So if there's not a lot of housing stock, when it comes to you getting financing for a townhome or a multifamily, a lot of your financing comes down to the appraisal coming in at the right value. If there's not a lot of housing stock and you go to get financing for a multifamily property, the job for the appraiser is much more difficult. They don't have comparable sales in the area, so it leaves a lot up for interpretation, and that's not a good thing for getting your loan to go through. So townhomes, there's a ton of townhomes around. It's easy for them to be able to find comparable sales to justify the value, and your financing is going to be easier to go through on townhomes. So there's your second advantage. The third advantage is really big. It's just flexibility. So if you've got 4 individual units in a townhome, you could sell one of those units. You could sell 2, 3, or 4 at any time. So your disposition of the asset is a lot more flexible. If you have a multifamily property, you have one owner who owns 4 units, and you can only sell all 4 units at one time. So you don't have as much flexibility, which is really, really important, right? You could do things like refinancing one unit if you have townhomes versus a multifamily, you have to refinance the whole building. So flexibility on a townhome is really, really critical, and a big advantage there. All right, so on the downside though, there's a downside to investing in townhomes versus multifamily when it comes to financing. So one of the things that investors, many investors are aware of is that your most advantageous financing comes in when you own 10 properties or less that are financed on your credit. Okay, so when you go and get another loan, if you have less than 10 loans on your credit, you're going to be able to get the most advantageous financing terms. When you get over 10, you run in, it's not going to go through a normal conventional loan product, and they get a little bit more expensive. The terms aren't as ideal. So when you buy townhomes, because they are individual units, if you bought a townhome with 4 units underneath it, that would be 4 loans on your credit. If you buy a multifamily property and it had 4 units in it, that would only be 1 loan. So there's a downside to investing in townhomes over multifamilies. But overall, a lot of advantages. And of course, JWB has been building townhomes to sell as turnkey rental properties for years and years and years now. So it's something that is right in our wheelhouse there.
I was hoping that you're going to ask me that question about why it's disadvantageous for the townhome financing thing, because I was ready to go with that. That's what I thought you were going to go with. And then and then I actually had to think. I was ready to raise my hand so that he could cue me up. But all right, now we know. Now we know. This is genuine. When he stumps me, it's genuine. All right, great, good explanation. Again, he did his walk and talk. You can see that in the group as well if you want to see the re-explanation of that or listen to this again. Mac, by the way, Lee in the group is putting in here that he has a $155K house and his insurance is about $314 per year. So there's a data point for you if you wanted to see it. Thanks, Lee, for contributing. And now Michael Foster has a question. When a tenant leaves under duress, how often do you find they trash the home or steal appliances, copper, etc. before leaving? Is that a common thing?
I want to set really low expectations here because this is such a sensitive thing for owners, right? I don't want to give you a rosy colored glasses answer. And I would expect that your house is going to get beat up. And part of this is because you're going to have somebody living in your house for 3 years, 4 years, 5 years, right? Our average tenant stays over 4 years. And they are not going to treat the house the way you do. Now, we build our houses to be beat up and to be able to withstand it, and so that it doesn't cost a lot on the turn. But I will tell you that you are not going to be happy if you were to walk into your house after that tenant left. You're going to look at it and go, oh my goodness, how could somebody treat it this way? I mean, that's just real. I mean, that's real for me. I have over 300 of these. Like, I know how it goes, right? Now, so, Mike, for your question, I think it was like, how often is it going to be beat up or things of that nature? I would just tell you it's going to be beat up every time. Just expect it, right? Now, objectively, expect about a couple $1,000s of turn net to you every single time. That's really what you should be holding us accountable to. And was there another part of the question that I missed, or do you think I addressed it?
He just asked how often do they trash the place? So I think there's probably a difference between beating up the house and just like really going to town on it. But
I don't have a good number for you, a good percentage. Everything's included in that average of $2,000 out of pocket. That average of $2,000 out of pocket really means about $3,000 of cost, because you get roughly about $1,000 of security deposit back. I'm just generalizing here. So, I mean, can it be possible that you can have a $5,000 turn? Absolutely. I've seen it, right? Can it be possible that you don't spend any money on your turn? Absolutely. It all just kind of comes out to the averages of about $2,000. I don't have more data to support anything more than that. We have great relationships with our residents, and we try to mitigate it as much as possible. But the way I would come into investing in rental properties is that I would expect that you're not going to be pleasantly surprised the way it looks if you were to walk into it right after they left. That's just real.
That makes a lot of sense. Aaron Compton in the group is I think he works with rental owners, and he says that it really depends on the area, right? Like also the likelihood of that happening. And I also want to give a shout out to Roldan Crepo. I think the example I gave from Lee, Roldan is telling me, keep in mind that the example I provided might be benefiting from a homestead exception. So it could be more affordable, so disregard if, he says, now he just corrected it. Homestead is for taxes, not insurance.
There you go.
All right, cool. Thanks, Roldan. I learned something new, right? I didn't know about that stuff. We got another question from John Sexton. Do you have any advice for new investors regarding LLCs? Is an LLC needed when starting out with the first few properties? Is it something that should be set up before investing, or wait until I have a few properties?
So I think this is more than just a Gregg giving you advice question. I think it's something that a lot of it is determined by your preference. It's your preference and how you want to deal with risk, right? So your risk tolerance. It also would require a conversation with, a legal team, somebody who obviously, just don't take my word for it. You're getting into some legal structure questions here. So go to a lawyer, CPA. We can certainly help you with that if you want to talk to my team about it as well. But here's my view on it. So when I started to buy rental properties, I looked at what was going to produce the most positive cash flow for me, what was going to create ease of use so that I could scale this thing the way I wanted. I was young. I generally have a positive outlook on people. I don't walk around that I am personally fearful that I'm going to get sued everywhere I go. And for me, even if something bad happened in my rental properties, that's why you have insurance, to be able to take care of those things. An LLC protects your assets, but it costs money and it creates complexity. And so you'll find additional costs when it comes to insurance. You'll find additional costs when it comes to simply setting up and maintaining your LLCs. And you will find that it is harder to get financing in an LLC. In fact, you do need to get financing in your personal name to be able to get the most advantageous financing terms there. Now there are strategies to be able to do it and end up with the property with financing and in the LLC. And that's a great conversation to have with my team one-on-one, so we can kind of walk through it. It gets a little bit involved. But at the end of the day, what I did is I started to build my rental property portfolio, and I kept the properties in my personal name, and I had a great insurance teammate. And I did that for a long time. I mean, I did that while my business partners and I each built up, together we built up about 40 rental properties. We had about each 10 in our names. They were all in our personal names because we got the loans in our personal names, and I didn't put them into a company at that point. That may not be the right thing for you. If you're at a different stage in life, if your risk tolerance is different, this is not one size fits all, but this is what I did. And I did it because I was comfortable with the risk, and it increased my positive cash flow. My financing was a lot easier. And then after you get to a certain number of properties, for me, it was roughly around 40. That's where we put that into our company name. And then, obviously all of our properties are in LLC now. We have a number of them. Generally speaking, some clients keep all of them in their personal name for forever, right? Some, we don't have another client who has 300. So I don't know how many other people would do that with 300 properties. Probably not advisable to do that. But it's very common. We have clients who own 10, 15, 20 rental properties. They're all in their personal name. And what helps them sleep well at night is they have great insurance to be able to handle that. There are other clients who their very first property or their first 3 properties, they put that into an LLC. So we can help you do either. I can't tell you what's right for you. I can just, my team will just kind of lay out the pros and the cons, the risks and the rewards, and you'll make the best decision for yourself, but all is possible there.
Okay. Great advice. Aaron asked a little while ago from the group, Aaron Compton, he asked, could you talk a little bit about the risk reward, the benefits of the private lending program?
Sure. So for those who don't know, private lending is a different investment than rental property investing. Private lending is basically, we'll say Aaron, for example. Aaron becomes the bank to a real estate developer like JWB, right? So JWB goes out and buys land, let's say, and to do that project, to buy that land and build a house on it, we're going to go to a private lender like Aaron, and we're going to ask to borrow the funds. And Aaron is going to earn an interest rate for us. And so the interest rate that we pay is 10%. And so every year, Aaron would earn 10% on his money because we're using those funds on a specific project to build that project. And then eventually we're going to sell that house. And that's how Aaron is going to get repaid. So that's the private lending program. It's a 3-year term. We pay 10% interest, and you can invest in private lending for as little as $10,000. So it's a great stepping stone, actually. The fourth thing that I was going to talk about as far as getting started to invest, if you don't have $40,000 of capital, private lending can be a great stepping stone for folks. You can get started. You can think about it earning 10% while you're building up the capital, and then it can easily be converted over to a rental property when you do have that capital. So it can be a great thing. Now, what are the pros of private lending? You don't have any maintenance or vacancy cost risk, right? If there's an overage on the build, which happens, if there's, an issue with the property, maybe the house is built and there's still your private loan on it is there, and there's a tenant there, and maybe the tenant goes vacant while we own it or whatever, you don't have that risk. Your payment is made to you every single month. It's a set interest rate. So advantages over at rental property investing is you don't have the maintenance and vacancy risk. Now, the disadvantage to private lending versus rental properties is you don't have the upside, right? So in rental property investing, you own the asset, right? So as the value goes up, and what history proves is over a market cycle in Jacksonville, values go up at an average rate of 4.3% per year. Well, when that asset continues to go up in value, your returns go up by actually owning the rental properties. And so if you shake down the numbers, and obviously we can go through this in more detail with you, Aaron. I know you're a great friend of JWB, so I would imagine you've probably had similar conversations with my team about this. At the end of the day, most likely you're going to earn more by actually owning the assets, especially if you use smart financing to be able to do this. You're going to own more, you're going to earn more. Your returns would be higher by owning the rental property portfolio, generally speaking, than private lending. And that's why many folks go to rental property investing specifically for that. Now, you do need to be able to stomach some of the ups and downs. So Mike Foster's question earlier, are tenants going to beat up the house? My answer is yes, it's going to happen, right? You got to be able to stomach that, right? If you're a private lender and you just want it to be set it and forget it, you never want to worry about maintenance risk. Well, private lending might be the better thing for you. Another time that private lending might be a better thing for individuals is if they have a very limited amount of capital and they don't have plans to purchase multiple rental properties, private lending might be a great place to go, because we believe so much in consistency. And if you do want to buy a rental property portfolio, I want you to get to 3 properties at some point, right? I want you to get there before the first tenant leaves. And, our average tenant stays over 4 years, right? So if you don't have plans to get to 3 properties over the next, call it 4 years, right? Maybe private lending is a better thing for you. You're giving up the upside, but you would have consistency there, and you wouldn't have risk of maintenance cost as well. And so you can achieve that with a lower amount of capital invested on the private lending side.
That's a great explanation. Can I ask you something? So Michael Foster, he put in the chat what I was thinking also. Can you please confirm, you said that all you need is a 10K minimum for private lending. Was that true? Or I thought it was $50,000.
It was 50. It was, I slipped that in there. I forgot to kind of highlight that. Yeah, it's been recent. We've just dropped that down to $10,000. I was talking to my business partners and I'm like, guys, our minimum for forever has been $50,000 to invest in private lending. And I'm like, I'm getting a lot of questions from the group and from other individuals to be able to start investing. What do I do if I don't have $40,000? And so I talked with my business partners. And so we came up with a great way for people to be able to invest in private lending with JWB. The minimum is $10,000 to be able to do that. So if it's something that you're interested in, of course, reach out to my team, chat with JWB.com. It's a great way to go and start that process right there. But yeah, that's a new thing. So Pablo, I'm glad you're finally paying attention, man. There you go.
Well, Michael asked the question, but for the record, I was thinking it too. I was like, should I correct him here? Should I let him go? That's really cool, man. That's awesome to hear. That makes me want to cut a check right now. Speaking of cutting a check right now, how far, at what point should somebody go with chat with JWB.com, right? Like let's say me, right? Like I think that I might have enough to invest in a rental income property. I'm obviously super bought into JWB. I'm clearly a fan. But I'm not sure if I'm ready for it or if I have enough money. And even if I did, I don't know if I would cut that check tomorrow. Is that still worth going to chat with JWB.com or at what point in the decision-making process should I go there?
Out of everything that we do at JWB, the most direct line to getting the best answers for you is to jump on a call with my team. I mean, we have 2 individuals. It's funny, both of them are named Mike. So you would get to talk with one of the Mikes. Both of these individuals have literally helped clients build over $350 million of rental property portfolios, right? I mean, Mike Stetson is one of the Mikes. He used to run our property management company. You're not going to find a more tenured team to be able to help you with your questions. And the other thing is that when clients come and talk to us, the first call has nothing to do with selling properties. It is all about trying to understand what your goals are, if this can even work for you, if we're going to be a great fit, and if you like kind of the way that we do business, right? It's very much a kind of a fact-finding mission and a listening mission. We don't even discuss properties on the first call. So that resource is the best thing. It's better than even me and you, Pablo, doing this, right? This is probably the second best thing as far as a resource for folks out there, right? But that is there. So for any of you who have these questions, all of these questions are fantastic, right? These questions, if you have them or more detailed questions, go to chatwithjwb.com. Start that conversation. I guarantee you are going to find value in that conversation if you have similar questions to this. If it is something that you're just way new in this, and this is maybe the first time you're hearing some of these concepts, you're not even following some of the things that, we're talking about. HOA you don't even know what that stands for, right? There's a much more passive way to kind of get some insight into what this is all about. And that's that web class that I put together a couple of weeks ago. And that's where I would go if you just want to just kind of spend 45 minutes to an hour really taking all this in. That's where I would go. You can go to jwbwebclass.com. Many times after that web class, you're probably going to have a million questions and probably want to go and talk to my team after that. But either of those would be a great resource for folks, but I would certainly encourage those to take advantage of the resource, which is the mics at JWB. They'll be a great resource for you.
I'm glad we explained the mics thing because I'm always saying, go to chatwithjwb.com, get on a call with the mics. I wonder if people thought that it was like a microphone or whatever. But yeah, there's 2 guys called Mike.
Mike and Mike in the morning, man.
Mike and Mike in the morning, RIP. Are those guys back? Mike and Mike in the morning? No, right?
They kind of broke up. I think they're each doing their own thing.
Yeah, there is.
I mean, they're trying to become me and you. I mean, what can we say?
It's tough. It ain't easy being the king. I want to thank everybody for being on this call today. I thought it was a really good call, right? Like we came in here with kind of no expectations. Let's see. Oh, who's the other Mike is what Mac is asking.
Oh.
So Mike Stetson, and who's the other Mike?
Mike Stetson and Mike Stewart. I forgot to mention Mike Stewart. Another incredible asset. Comes with a world of experience. So you and Mike has been on it. Mike used to manage our service team. So you want to talk about, so that's what we hire, we promote from within. And so that's the quality of the individuals that you'll be speaking with. So you'll love them both. There
you go. That was Mac McGowan asking that question again. By the way, he cleared up that his nickname is Mac because his last name is McGowan. So it wasn't that his parents called him Mac McGowan. He put it out there for us. Thanks, Mac. Thanks for contributing, my friend. And like I said, thank you, everybody. We still have 16 people with us on this call. We had about 10 or 11 people on Facebook throughout this whole time. We still have 9 of them on Facebook hanging out with us. This is awesome. All the questions were great. We got a last minute question. I'm gonna get it in. If I keep talking, we're never gonna get off here. Jeremy Bowen asks, are you guys primarily in new builds or existing inventory?
Great question. So we are primarily in new builds. So over 75% of the inventory is going to be new construction. That does not mean that we don't love renovations. Obviously 25% of what we do is renovations. That's really market driven. So if you talk to different providers in different parts of the country, a lot of folks have challenges providing inventory, and it's because they don't do new construction. But for many years, since 2011, we built up our inventory of new construction lots. And for many years, we bought more lots than we were going to build and sell. And we did it because we knew that inventory was going to get scarce at some point, and that's where we are right now. So over the years, we build up the new construction level to be able to reach the amount of sales that the demand that we have for clients. And right now, if all we relied on were renovations, it would be tough to supply that. That's what you're finding in other markets and other inventory providers. So we love them both at JWB, but you're going to find that over 75% is new construction. So high likelihood that would be in your portfolio for you, Jeff.
Yeah, Jeremy, one of the things that I noticed when I was just getting familiarized with JWB so I could host the show and be a part of this little experience is that you guys have 3 years worth of land inventory that you buy. You're buying 3 years ahead so that you have 3 years of forecast to build enough new construction to meet the demand. And that just kind of blew my mind when it happened. So it sounded like, Jeremy, you might be new here to the ecosystem. So I wanted to put that out there because I just think it's really cool.
Absolutely. You picked that up in the TMM, huh?
I picked that up in the TMM. We haven't talked TMM in a while, man.
No, it's tough with COVID, the Tuesday morning meeting. We'll get it back. We do have it back now, but it's tough without getting all 80 people in one room.
Yeah, man, I miss that vibe. So just for anybody that hasn't been with us for a while, JWB has this like full staff meeting of like 85 people every Tuesday. And Gregg strategically invites any kind of like new team member or somebody's going to bring on. He's like, oh, I want you to come to this meeting. And he doesn't, or at least he didn't tell me anything. And I walked into that thing and it's like, you think about walking into a 1 hour long corporate meeting with 85 people. It sounds like the worst experience in the world. And you get there and it's like the happiest experience of people sharing wins and reinforcing core values and then value add presentations and everybody speaks. It's one of these things that I'm like super obsessed with. And I can't wait till, we're over this COVID thing and everybody can get back together and I can go be part of that team again. So that's what the TMM is, which at first I thought it was total man mode, what that stood for, but I didn't. So anyways, thank you everybody. I think I'm going to cut it off for questions or else we're never going to get off this call. But if you have any more questions, I can leave this on a little while longer and we'll keep it flowing and you can put them in and we'll have people follow up. Just put in your full name into the Q&A box and we can have somebody follow up. If not, join our Facebook group. Go to jwbfacebookgroup.com and hang out with us. But I really, really want to thank everybody for being here. I want to encourage anybody. I'm not kidding when I say I'm going to go to chatwithjwb.com because I've been thinking about all this stuff. I'm on these calls. I think it's time for me to. Yeah. I'm in.
All right, Pablo, you're in, buddy.
Yeah, you took the pressure off me from thinking that like if I don't get on a call and I'm not going to buy something, I feel like a jerk, right? So like. You took that pressure off. So I'm gonna do it. So go to chatwithjwb.com. If you have any questions, if you want your own your own experience. I know both of the mics. They're awesome guys. So I'm looking forward to the phone call. And again, if you don't want to talk to a human and you just want to get familiarized with what JWB is and the way that they go about allowing people to buy rental income properties, go to the jwbwebclass.com and, get educated. And then you can either join us again. We do this every Thursdays at 12:30. We do the Q&A. Tuesdays at 12:30. We do a more of an interview style format where we generally have some structured content that we're presenting, or we'll have a best-selling author, or we'll have a super fan client like Lee this week, which is awesome. Lee Bishop, thank you for being on. And we always have some content rolling in, but thank you everybody for being here. Really appreciate it. This is a lot of fun. Greg, I'll let you take it away.
Always fun, brother. I appreciate everybody being here, contributing to the community. It means so much to me. It means so much to Pablo. And we will catch you guys next Tuesday for the next show. Have a great time.
All right. Happy anniversary to the Richies.
See ya.
See ya.